Thanks for coming today. It's a great turnout. It's a true honor to introduce President Neel Kashkari, who has graciously agreed to share his invaluable time with us today. Let me give a brief introduction of President Kashkari. Neel is the president of the Federal Reserve Bank of Minneapolis, which is one of the 12 regional banks of the Federal Reserve System. The Minneapolis Fed oversees the 9th District, which covers Minnesota, North and South Dakota, Montana, northwestern Wisconsin, and the Upper Peninsula of Michigan. Before entering the world of finance and public service, Neel began his career as an aerospace engineer, contributing to technologies used in NASA space missions. He later held several key positions in both the public and private sectors, most notably serving as Assistant Secretary of the Treasury during the 2008 financial crisis. In that role, he oversaw the Troubled Asset Relief Program, widely known as TARP. Neel became president and CEO of the Minneapolis Fed in 2016, and he currently serves as a member of the Federal Open Market Committee, which is responsible for setting U.S. monetary policy. So please join me in welcoming Neel with a big round of applause, please.
Well, thank you, Casey, for hosting. Thank you all for being here. I really appreciate it. My colleague, Andrea Raffo, who's our chief economist at the Minneapolis Fed, are here to participate in a Bank of Japan monetary policy conference that they have every year. This is my third or fourth visit to Japan. I always love visiting Japan. It's a wonderful country, and everybody's very gracious and welcoming us, so I appreciate being here. I'd love to just have an open discussion about whatever's on your mind. There's a lot going on in the global economy with tariffs, with interest rates where they're going. So I think there's a lot that we can talk about here today. So where would you like us to go?
So thank you so much. Well, this is actually a very special moment for me personally, because I studied at UCLA alongside with your Director of Research, Andrea. And during that time, I was inspired by macroeconomists like Leo Hanian, Gary Hansen, Hal Cole, and Andy Atkinson. And all of them had strong ties with the Minneapolis Fed. So to me, the Minneapolis Fed always stood out as kind of a sacred place where macroeconomic superstars were producing influential academic research. So my first question is, how did the Minneapolis Fed come to be such a powerhouse of academic research in macroeconomics? And how are you working to maintain and build this strong culture?
Well, long before I got there, the legend is in the 1970s and 1980s, they attracted a group of researchers who had very out-of-the-box thinking about how the global economy works and how monetary policy works. My impression is when they came up with their big ideas at the time, they were not embraced, that they were shunned by the traditional economics profession, but over time, they proved to have been wise and that it really did change, and rational expectations, I know, was a big feature of their work. So much of economics is about what you believe is going to happen. If you believe that inflation is going to be high in the future, that makes it more likely to be true because your behavior changes. And if all of our behaviors change, we're going to go to our boss and say, hey, inflation's high, you need to pay me more just so I can pay my rent. Then your boss says, okay, I need to pay my employees more, so I need to go to my customers and charge them more. And so just if everybody believes this, it makes it more likely to be true. And so the Minneapolis Fed was at the forefront of understanding how this expectations can become a self-fulfilling prophecy. But it also, once you recognize it, it can be a very powerful tool to be utilized for good. So it's not just bad things, it can also be utilized for good. So at the Federal Reserve and at the BOJ and at central banks around the world, credibility is absolutely key to the power that we have. If market participants and consumers trust what we say, so we say we're going to do what we need to do to get inflation back down, and you trust us and you believe it, And then it makes it more likely to be true. And then we actually don't have to raise interest rates quite as high to get inflation all the way back down. Expectations does some of the work for us. So it turns out that this radical idea of expectations is very, very powerful in economics. It can be powerfully dangerous, but it can also be powerfully good.
Thank you so much. That's very insightful. I want to further ask, how do you balance the academic research that you do at the Minneapolis Fed and how to incorporate that into policy making?
So this is a big debate because Federal Reserve banks and Minneapolis Fed have a team of excellent PhD economists who spend some of their time doing academic research that maybe they would do if they were professors here or professors at the University of Minnesota. And so there's a question, well, why do we hire them? Why do we pay them to do in Minneapolis, in our Fed, what they would do at a university? If they're going to do the same research, let them go to the university and do the research and let the university pay them. Well, what I've observed myself is that the research topics that they choose to investigate are influenced by the fact that they're in the policy environment. So these same economists that I work with, so Andrea leads a team of economists, and we're debating every day what's happening in the global economy. So we have this trade uncertainty and these tariffs that are being applied. What's the effect on the US economy? What's the effect on inflation? What's the effect on the global economy? We have theories, but it's not quite so clear that we know with certainty what's going to happen. So they're with me every day debating these range of options and how monetary policy could respond to that. And I need their help, and they help me a lot, think through scenarios. But then what I've observed is that when they go off and say, well, what research topics are they now interested in exploring, it sticks. And they're more likely to pick research topics that are relevant to the policy mission of our institution. And so what I've found is I've said to them, I don't want to get personally involved in picking which economists you hire. Hire the very best economists you can, as long as they're policy curious. If they're policy curious, being at the Federal Reserve or being at the BOJ, they will find that inspiring to help shape the research topics that they pick. And it's been true.
Thank you so much. That's really inspiring to hear. I think it sends a strong message to students and researchers that rigorous academic work can have a real-world impact. So that's a strong message to the students here, especially research students in macroeconomics. So thank you.
Yeah, I mean, one of our economists, Javier Bianchi, wrote a paper in December about how monetary policy should respond to tariffs. He wrote it in December, before the tariffs were announced. And now it's getting a lot of attention. Now, personally, I don't agree with him, okay? But that's okay. I mean, he did rigorous academic work that's getting a lot of attention. There's a lot of merit behind his ideas. But that makes me better as a policymaker. So if you were to sit in on our policy deliberations that we have, they're like intellectual wrestling matches where they're telling me where I'm wrong, I'm telling them where they're being too theoretical and not being practical, and we're trying to debate all the different ways of analyzing this problem to understand what are the different options for policymakers. That's a very interesting intellectual environment to be part of. I enjoy it a lot, I get a lot out of it, and I want people to challenge me. So even though Javier wrote a really good paper that's getting a lot of attention and I don't agree with his conclusions, at least not in this moment I don't agree with his conclusions, I still benefit. I benefit tremendously from having him there pushing me and challenging me with his ideas.
Excellent stuff. Thank you so much. Let me talk a little bit about the Japanese economy. So we all know that the Japanese economy has faced prolonged challenges since the bursting of the asset price bubble in the early 1990s. So I wanted to ask, do you think elements of Japan's post-bubble monetary policy, such as the zero interest rate policy and the early use of quantitative easing. Have these served as useful references or perhaps cautionary tales to the United States during the global financial crisis or even during the pandemic?
I mean, I think there's a lot for us all to reflect on. I would often hear criticisms that Japan's policymakers were simply not bold enough, that if they had only been bolder, they could have gotten away from the low inflation and the zero lower bound sooner. I'm skeptical of those claims. I think that there are broader forces that are affecting these economies that are one of my conclusions, now this is my 10th year at the Federal Reserve, one of my conclusions is that monetary policy helps get there a little bit faster, but it doesn't actually change the destination. And so if the demographics of a society, an aging society with slow population growth and otherwise low productivity growth, those are much more powerful forces than monetary policy itself. And so I don't know, for me, one of my takeaways is let's be humble about how powerful, monetary policy can be powerful, but some of these other forces I think are much, much, much more powerful. Think about current events. So the US is trying to negotiate ultimately a new global trade arrangement. And I've been saying this out loud a lot. You know, why does the US have a trade deficit? The US has had a trade deficit for decades because the US is the premier destination of investment capital around the world. Those are two sides of the same coin. So if we're not going to have a trade deficit anymore, then we're not going to be the premier destination of choice for investment capital around the world. So that means we're going to end up at some new equilibrium. What is that equilibrium? I don't know. The Federal Reserve cannot affect it. All we can do is manage some of the turbulence as we get to that new equilibrium. So again, I want to be humble about, well, if only the Fed, somebody might say, well, if only the Fed had done a better job, the equilibrium would have been different. Not true. And so maybe the low growth environment that Japan was in with zero interest rates, low inflation, maybe there wasn't much for monetary policy. I mean, maybe monetary policy makers did what they could, but these broader forces are just doing their thing. I don't know. What do you think? You're here.
Absolutely. So productivity growth and demographic trends, I think, are creating the long-run trends in the economy. So in that sense, I totally agree with you. Which is actually related to my next question. So one more thing that was going on in Japan was population aging. And I think the general consensus is that aging had some deflationary pressure on the prices through the dampening of the demand side. So my question is that in the US, population is aging at a gradual rate compared to Japan, that is. But where do you think the trend is heading towards, and how do you think this will affect your monetary policy or your inflation rate?
Well, one big difference between Japan and the US, you're right, we are aging, not quite yet how Japan is. But immigration has been such a powerful factor in American demographics throughout our history. Right now we're at an inflection point where there's a pushback on immigration in the US, but over America's 200-year history, immigration has played a huge role. And I talk to people, elected leaders, from both parties, Republicans and Democrats, and the vast majority of them agree America needs more immigrants. But most Republicans will say, but they need to be able to control the immigrant flows that are coming in. So the big political dynamic was in the southern border coming across Mexico, millions of people, literally millions of people were coming across, and there wasn't clarity on who was coming across, et cetera. So I actually think there's an opportunity where there's going to be political consensus to design a new immigration system in America that is selective on, okay, we need these skills. We need farm workers for farms, we need healthcare workers for our hospitals, we need engineers for our computer companies, and you map it. Many countries do this, where they say there's certain skills needed in the economy, design the immigration system to get those skills. So that culturally is available to America. I think that culturally is more challenging for Japan, just historically. And so, in some sense, I feel optimistic about America's position on this, because we at least have the tools. If we get our political consensus right, we have the tools to address our aging population. I think it's harder if culturally it's not been part of your story.
Yes, so immigration has been a big issue in Japan right now. At the moment, the government is trying to increase immigrants in particular sectors, but at the rate of population aging and even the population decline in Japan, I think immigration is not really enough to solve the issue. So do you have any other insights on how Japan might be able to resolve the issue of labor shortage?
Well, I mean, if you're not growing the people domestically and you're not bringing them in from abroad, I mean, maybe robots will save the, I don't know. I mean, I go around in my region of the country, of America, and I say economic growth comes from two things. It comes from productivity growth and population growth. And if your population is growing slowly, you have fewer workers to produce things and you have fewer consumers to buy things. So your economy is going to grow more slowly. And that's math. So how do you get out of that? You can either try to pay families to have more babies. Doesn't work. I haven't seen many countries have tried it. I've not seen any evidence that it works. Number one. Number two, you can embrace immigration. Or number three, you will have slower growth. That's it. Those are your options. And so that's it. I mean, it's like math. So either you grow the people at home, or you bring them in, or I guess you pray for robots. But I don't know. What do you think?
So yes, I'm counting on the robots. So
I see.
In Japan, we are facing labor shortage, especially in particular sectors. So the demographic is aging, and there's an increasing demand on caregiving.
Yeah.
So should we have an expansion in the service sector, in the caregiving sector, by employing more people? That's not really happening at the moment. We are increasing immigrants in this particular sector, but that's not enough. But gradually, robots are introduced into the caregiving sector.
But that seems like a very different, I mean, as an outside observer, that seems like a very difficult assignment for a robot. Think about this. 5 years ago, I heard from experts in Silicon Valley who were convinced that fully autonomous self-driving cars and trucks were right around the corner. And we are still years and years and years away from that being widespread. In the US, many of the test vehicles have been shut down, companies have been shut down. There's still pilots going on. But we were told that the long-haul trucks that drive all the way across the country, that's a pretty easy problem to solve, relatively speaking. Because you get on the highway and you drive straight for 2 days. Even that has not been solved yet. That strikes me as a much more solvable problem than a robot caregiver to an elderly person. So I guess my guess would be maybe the people who would have been driving, if you can solve the driving problem, then you don't need taxi drivers, and then you can reallocate some of those people to the more complicated task of caregiving. I'm just guessing.
No, that's, I think, absolutely correct. So the portion of caregiving that you could rely on robots is limited. So you will have robots that will automatically bring up your bed when you feel like you want to wake up and have some meal. Then the robot will do that for you. But this is the robot, and not really.
That's not what I think of when I think of a robot.
Absolutely. It's not like running around.
Yeah.
Taking care of you. So, but yes, that's the situation in Japan, and perhaps since Japan is the leader of population aging, it might be a new trend in the world. So that would be my view. So one last thing I wanted to ask. So I think you always get this wherever you go, but cryptocurrency is getting so popular around the world. And how is your view on this new tool? Is it a fear for monetary policy? Is it destabilizing? I want to know what you feel about this new technology.
It's not a fear, and it's not destabilizing from what I can see so far. So Bitcoin, let me ask you this. Let's do an experiment right now with all of you. Let me see a show of hands. Who has used some type of generative AI tool in the last week? Okay, virtually every hand has gone up. Who here has bought or sold something using Bitcoin ever? Okay, not a single hand has gone up. Bitcoin has been around for 15 years, and there's still no legitimate use case in a developed economy anywhere in the world, other than circumventing banking regulations or engaging in some form of illicit activity where you don't want to be able to trace it. 15 years. And generative AI is a couple of years old, and we're all using it. And so, so one of them, there's actual utility. One of them is actual productivity enhancing. One of them is merely an instrument of speculation. Now, I'm not opposed to speculating. If you want to speculate on it, speculate on it. You're probably too young in the audience, but 15, 20 years ago, people used to speculate on Beanie Babies. Maybe Pokemon cards. I don't know. I'm sure. So speculate all you want. I don't see that as a competitor to the dollar. I don't think that is a problem for central banks. I do think it's a problem for people who think it's going to keep going up and up and up, and then at some point it doesn't go up, and then they lose money. I feel bad for that. You know, we were told at some point that Bitcoin was an inflation hedge. Then when inflation took off and the Federal Reserve raised rates, and the other banks raised rates too, not just the Fed, Bitcoin got crushed, demonstrating that it was not an inflation hedge. It was just a levered speculative asset, essentially. And so you know what it is, and then that's okay.
Thank you so much. I have many more questions to ask, but I don't want to hog all the time. So I think it's time to open the floor for the Q&A session. So if anyone has a question, please raise your hand, and microphones will be roaming around.
In the back over there.
Thank you, sir. Thanks for your insight sharing. And my question is about the tariff and the trade war between US and China. So my question is, given the long-term structure shifts caused by the US-China trade war, including reshoring, decoupling of supply chains, and the potential persistent inflationary pressures, how do you think those developments challenge the Fed's traditional monetary policy toolkits over the next decade?
Well, how are tariffs going to change our toolkit? I'm not sure. Eventually, as I mentioned earlier, eventually the global economy will settle into this new equilibrium. And what do I mean by that? Eventually, supply chains will get redesigned. Maybe some manufacturing will come back to the US. Maybe it'll shift from China to other countries. You know, we'll see. And once that settles out, if the Fed is committed to our jobs, which is to keep inflation at 2%, inflation will get back down to 2%. The price level will be higher by some amount, and the interest rate that achieves 2% in steady state may be different. But I don't think necessarily that, I mean, I think we'll be able to achieve our 2% inflation target once we get to that new equilibrium. I don't know how long it's going to take to get there, and I don't know what that equilibrium is, but I'm confident that we can get back to a 2% inflation rate. Again, the price level will be higher, and the interest rate environment may be different, maybe higher, consistent with that 2% inflation. Does that make sense?
Yeah, thank you.
Thank you.
Any other questions? Oh, right there.
My name is Neel Kashkari. Sorry. I hope you have a wonderful time in Tokyo. My question is regarding President Donald Trump's. He recently mentioned that he has plans to privatize Fannie Mac and Freddie Mac in America. Like, you have been into that situation in 2008. What are your thoughts about his ideas of privatizing Freddie Mac and Fannie Mac again? Like, there could be some negative consequences regarding that matter.
So I don't know the details of what the administration is planning. So I'm not really in a position to comment on their specific proposal. But as a general matter, the question that I would ask is, so Fannie Mae and Freddie Mac are these quasi-government institutions, quasi-private, that provide guarantees to mortgages, what we call conventional mortgages in America. So if you're buying a normal house in America, you could go get a mortgage that's effectively subsidized by Fannie and Mae and Freddie Mac because they're providing a government guarantee on those. So the question is this: who takes the risk if there are losses? If it's a true government guarantee, then the US government, the US taxpayers take the risk. And who's getting the upside of the privatization? So one theory is they should just be fully nationalized, where the government takes the risk and the government takes the upside of the fees they collect. The other extreme is they're fully privatized. It's a private guarantee and the private sector gets the reward. What got them into trouble in the 2008 was that the private sector was getting the upside and the government was providing the guarantee, and that misaligned incentives. And so I don't know enough about what the administration is planning. Which of those three scenarios, that's what I want to understand.
Can I ask a question? He actually said that there were some talks that Bill Ackman, who actually owns some share of Freddie Mac, I think Penny Mac, said that if it's privatized, it will be better for the U.S. real estate market. Do you think, if it's fully privatized as it was before in 2008, do you think there will be similar negative consequences that will happen, or do you think it's a bit different now because the policies have changed?
Yeah, I don't know. I mean, I think it would also depend on if you have a situation where, like in going into 2008, there's a regulator that's supposed to be regulating them and making sure that they're not taking excessive risks. I think that regulator failed in their mission going into 2008, and they took much bigger risks than they appreciated. You'd have to solve the regulatory portion of this and make sure that regulator was doing the right things so that they were not taking excessive risks. And so there's a lot of questions that I would need to answer.
Thank you. Any other questions?
I'm Ippe Fujiwara, Professor of Macroecon here. Thank you very much for the very insightful discussions. I'm particularly impressed by your statement that the policymakers should be very humble about the views on the economy, because even behind a very simple event, there are so many counteracting forces. But at the same time, as a policymaker, so that maybe the public would like to have a more clear and simple messages. So how do you take the right balance between the complexity of the reality and the simplicity of the explanation? That's my question.
It's tough, and I don't think I always get it right. One thing that's very clear that we try to communicate is what are our goals. So Congress has given us our goals: 2% inflation and maximum employment, as many Americans working as possible. And oftentimes those things they work together, sometimes they're in tension. And so then what we'll say is, okay, this is what we're trying to achieve. We were working on the last few years what we call the soft landing, bringing inflation all the way back down, keeping the labor market strong, everything's going quite well. Now we have these tariffs that's created a lot of uncertainty, probably pushing down economic activity, probably pushing up inflation. And so we're waiting and seeing. We're going to see how this shakes out. Where's the effect bigger? And then we're going to move. I think speaking about things at that level, people can understand that. And the details of, well, the tariff is hitting an intermediate good and it's going to take a long time to flow through to final prices. I think those details matter to us and they matter to you. But I think ultimately to the public, what they experience is my job safe? Is inflation low? Is my family falling behind, or are they getting ahead? I think those are the core things that we need to communicate as simply as we can. But it's not easy, and we're not perfect at it, certainly.
Thank you. Any other questions, comments?
Thank you for coming to Keio University. I'm Masahiro Endo, a faculty member at Keio. And my question is quite simple about the local economy in your field, Minneapolis. And how do you estimate the impact of the current president policy, like trade policy or immigration policy, on your local economy in the Minneapolis state? In Minnesota state.
Yeah.
Thank you so much.
So let me back up. I'm going to answer your question, but let me explain why there are 12 Federal Reserve banks in the U.S. This was a negotiation in Congress 100 years ago where they didn't want the central bank all housed in Washington, D.C. They wanted it spread out around the country so the different regions of the country had a direct voice in monetary policy and the policy process. Now, ultimately, when I make a recommendation for interest rates, I'm not picking an interest rate that's customized for Minnesota. It has to be an interest rate for the United States as a whole. So my recommendation is, what do I think is right for the country as a whole? But it is somewhat informed by what we're seeing locally. So I'll give you an example. We get lots of data on the US economy and on the global economy, and usually the data that we get is confusing. Some data shows strong growth, some data shows weak growth, some data is lagging, some data is forward, futures, and it's a confused picture usually. So how do you make sense of that? Well, how I make sense of that is I talk to a lot of businesses, small businesses, mid-sized businesses, large businesses. I talk to labor unions to say, what are you actually experiencing on the ground? What's actually happening in your business? And usually from those conversations, I can start to make sense of the conflicting data that we're getting. And then that makes it clearer for me to make a recommendation for the US economy as a whole. And so it's not like we're trying to say, well, this is what inflation is in Minnesota. That doesn't matter that much. It more matters, what does it tell us about inflation for America as a whole?
Excellent.
Thank you so much.
Thank you.
Yes, I saw a hand here.
Hello. I'm a student in Faculty of Business and Commerce. Thank you for great opportunity. I have one question that I heard the news that Moody's has downgraded the U.S. government's credit rating as the last company of the biggest credit rating company. So I just by my curious, what do you think about the news, and does it actually affect a lot to American economy?
I don't know that the downgrades of the credit agencies themselves matter that much. I think the information that led to the downgrade matters more. And so, there's a question that we're all wrestling with right now, which is all around the world, advanced economy, long-term bond yields are going up, including in Japan, a lot. Why is that? Why is it that now, as opposed to 6 months ago, there's some reassessment going on, apparent reassessment going on the fiscal position of all of these countries? What has changed? And so yes, there's tariffs have changed and trade wars have changed, but has that all of a sudden made Japan's fiscal position more precarious? That is not obvious to me. And so there's a lot of churn, a lot of changes underneath this that I think we need to try to understand what has fundamentally changed, leading to these yields to move. The chair of the Fed, Jerome Powell, has said many, many, many times that the U.S. is on an unsustainable fiscal path, which is if you just forecast out where the debt and deficits in America are going, they go way up. And 6 months ago, people would ask me, is America's debt to GDP, let's say 100% debt to GDP, is that concerning? How concerning is it? And I would say many countries have gotten into trouble having 100% of debt to GDP. Say Argentina. Japan has twice as much debt to GDP and seems to be fine. And I would say to them, is America more like Argentina or more like Japan? But now that Japan's yields are moving, maybe I shouldn't use that analogy anymore. So I don't know the answer. Is what yet is driving this reassessment? Is it a short-term reassessment? Is it a long-term reassessment? I don't know. It's going to go back to things like if the U.S. economy's productivity picks up, it's been high for the last few years, then we should be generating more resources. We should have stronger growth, and then that could help us with our debt to GDP position. Maybe not. Maybe that's not going to happen. So I don't have a good answer for you yet. It's not the downgrade that concerns me. It's these other factors that I think are we need to really pay attention to.
Thank you.
Martia?
This question's I'm Amartya Lahiri. I'm visiting from UBC. I'm visiting Keio for this month. I guess my question's about Fed communication. This 2% inflation target is well understood, at least in central banking circles and technical circles is well understood. And yet, when I do any armchair surveys of people, there is complete confusion about the level of prices and the rate of change of prices. And it has created, almost every time I go to the US now, because I'm living in Canada, you ask people and say they lie. Prices are higher, and these guys are telling me that, inflation is down. Inflation is not down. Prices, I'm paying this much, I used to pay that much. So this is about communication, and it's a fundamental challenge in some sense about, so what is getting passed through, how are people parsing data, or what the Fed is communicating about what they're seeing. How do you see this challenge? I mean, is this something that, at least people are thinking about inside, about communication and this first moment, second moment problem? And sort of related to that, I'll just tag on one thing, which is 2% so if I go to 5 and then I come down to 2, do I declare victory, or should we be targeting average 2%, which would then mean I should go below? What's the take?
Yeah, so it's a huge challenge, and it's a huge challenge politically for the Fed. It's a huge challenge for elected leaders for exactly the reason you said. I have not heard a solution to this problem. I think the only solution is once we get inflation back down to 2%. What's great about 2%? At 2%, nobody thinks about it. Nobody cares. I mean, they do care, but really, it's just not a factor of their daily lives. I don't remember who said it. Was it Greenspan? Somebody like that a long time ago said, the thing is about 2% inflation is people are not spending time in their daily lives thinking about how they have to plan for or adjust their behavior for these minor price changes. So I think that's where we need to get to the point where people are not thinking about it anymore. I don't know how to solve the specific problem that you've identified, which is correct. The difference between prices are higher, stop telling me that you've solved the problem, prices are still higher. Then related to the, if we've overshot, do we want to undershoot? We're undertaking every 5 years now, the Federal Reserve undertakes a review of our monetary policy framework, our approach to monetary policy. This is ongoing right now. I don't want to prejudge it. But in our 2020 framework review, we came up with something that we call flexible average inflation targeting, which basically means that, hey, if we're at the zero lower bound, we're going to aim to try to catch up on the inflation on the upside. But if we have a period of high inflation, we're not going to try to cause deflation to catch up on the reverse. And so that's a point of, that was by design, because deflation is very challenging and painful for economies. And I'm confident we're not going to adopt a deflation strategy in our new one, but what the details are, we're still working through.
Thank you. Any questions? And
Thank you very much for coming today. So my question is that to what extent does FOMC consider the stability of the foreign exchange market and
The stability of what?
foreign exchange market?
Foreign exchange market?
Foreign
exchange
exchange,
market.
yeah,
Okay,
foreign
got it.
exchange.
Yep, sorry.
In terms of the dollars being the base currency of the world when deciding policy interest rate.
So we don't specifically target the dollar with our interest rate policy. We do have economists running models of the global economy. And the global economy matters for America. So when we move interest rates, our models will tell us, well, we think that the dollar will move up or the dollar will move down. That will have some imprint on inflation then that comes back to America. It'll also have an effect on economic growth around the world, which then has an effect on America. So we do care about the global economy a lot, but ultimately we are trying to achieve our 2% inflation and maximum employment for our domestic economy. And these are feedback loops of how our policy choices might have unintended consequences ultimately that affect America.
Thank you very much.
Have any other questions?
Hello, thank you very much for your presentation so far. I have a question regarding expectations. So you've already mentioned that they're incredibly important to your work, and there's a growing body of literature on how exactly expectations are formed. So thinking about selective memory recall or different cycles of updating of agents, households consistently overshooting with their inflation expectations. So how much is this already considered in your policy and especially communication decisions at the Fed?
Well, you know, my colleague Andrea and our team of PhD economists will know infinitely more than I do about the literature that you spoke about. My humble view is that each episode seems a little bit different. You know, what did we all take from, you know, I'll give you an example. So I was at the front line of the 2008 financial crisis. And in the 2008 financial crisis, one of the things we learned is when people got scared, they ran to US Treasury bonds. That's the source of safety. And then when COVID hit, they ran from every security you can imagine. And they just wanted cold, hard cash, physical cash. And in the US, we literally almost had a run on cash, where people were going to the bank and trying to withdraw as much cash as they possibly could. And then in that moment, the Federal Reserve had to intervene in the US Treasury market to stabilize the Treasury market. This is not exactly answering your question, but that's just an example of two crises in the moment, very different responses from people and behavior from people in a moment of fear, in a moment of panic. And so this goes to a debate that we're having right now, which is the US and many countries have had elevated inflation for 4 years. How many years can we go before inflation expectations unanchor, lose their anchor? I don't know. And with all due respect to the researchers in the room, if you had a very sophisticated model that said it was 5.2 years, I'd say, you know, I'm skeptical of how much confidence I'm going to put in your model of 5.2 years. And so you said it right. How do people form expectations? How do societies form expectations? How do societies' expectations change? This is a very inexact science that we're talking about here. And when we can examine with great academic rigor a specific case, but I'm going to be cautious before I draw firm conclusions about future events when the shock is going to be totally different.
Thank you.
Thanks very much for a great talk. In Washington, especially in Congress, is there a really clear realization of what you said about the relationship between the trade balance and financial inflows?
I don't know. I don't know. I've been saying it I gave a TV interview, CNBC in the US, and I said it just like I said it here. And the anchor, who's pretty sophisticated, said, nobody's ever explained it like that before. And said, well, I think we should explain it like that.
I think we have time for one more question.
I have a short question regarding with a BRICS country. There were many news relating to BRICS country, and they are planning to create their own currency, like BRICS currency. Personally, does it concern you? Thank you.
It doesn't concern me. I mean, ultimately what you're asking, I think, is the US dollar and the premium position that it has played in the global economy for decades, and what is going to threaten that potentially, and will there be a competitor? And I always describe it this way. The economy that has the reserve currency is the major economy that investors around the world have the most confidence in. And so one thing is, other countries could improve their competitiveness. And so let's say if the dollar is here, other countries could improve their competitiveness, and now let's say the euro becomes the reserve currency of the world. That's conceivable, or the yen. Or alternatively, America could weaken our own competitive position, and then that similar shift could happen. So I guess I'm less concerned about BRICS countries coming together and trying to create their own basket that's going to compete. Certainly, I think China has enormous economic challenges that they're facing going forward. If America can get our political system kind of to come together and make some strategic decisions, I think America's competitive fundamentals are very, very strong. But we also can't take that for granted. And so I think America should focus on getting America right, and then I think we'll be very competitive in the world.
Thank you very much. So thank you so much for your time. Unfortunately, it's the time's up, so I'll have to end here. Do you have any final remarks?
Well, thank you for really, I wasn't sure what to expect from this conversation. Obviously, this is a highly informed, educated, sophisticated group, so I really enjoyed the talk. You challenged me with a bunch of questions I don't normally get. I've gotten the Bitcoin question before, but many of the other questions were ones that made me think, so I really appreciate it. I've had a wonderful time in Japan. Unfortunately, I have to go home tomorrow, but I have a few more glorious Japanese meals between now and then, so I can't wait.
Okay, thank you so much. Please join me in thanking the President for his invaluable time and the excellent experience that we had today. Thank you so much.
Thank you very much.
Thank you so much.